everyone and welcome to this new video. Today we are going to talk about an important stage in the life cycle of a startup, the Series A round. It's a complex and challenging topic, but it also represents a unique opportunity to accelerate business growth. In this video, we'll explore every detail of the round, from the requirements to investor expectations, to pitching strategies, and the effect on corporate control. So let's get started right away. But first and foremost, let me thank all new subscribers. We recently passed 1700 subscriptions and we are thrilled to bring you cutting-edge financial content every week. So, what is a Series A round? Series A round represents one of the first major funding rounds for startups. It follows the seed round, and the Series A round, the main focus is no longer validate, but rather start scaling. Funds raised in an early stage round are often allocated to various strategic objectives: team expansion, investment in marketing, technological development, or expansion into new markets. An essential aspect of this round is that involves a long-term view. So, the Series A round investor come into play to see the company grow over time and achieve a return on investment through future funding or potential exit. Investor requirements and expectations. Investor in the early stage round expect a startup to have already demonstrated its ability to create value. While requirements can vary, investors generally focus on a few key aspects. Product and traction. Investors want to see the product or service stable and scalable. Traction metrics, such as the number of active users and month-over-month growth rate, are crucial to show that there is a real demand. Market test. At this stage, it is not enough to have a great idea. Investors want evidence that there is a market and that the product meets a real need. Sustainability and business model. The business model should be tested and proven effective, with investors seeking a clear understanding of cost, revenues, and potential profitability. And team is often said that investors invest in people first. The team's skills, experience, and cohesion are key elements in assessing the startup's ability to execute the growth plan. And unit economics, customer acquisition cost, long-term customer value, payback period data become crucial elements in understanding the sustainability of growth. So now let's have a look about structure and operation. A Series A round can vary significantly in terms of amounts and conditions. On the average, early stage rounds range between 2 and 15 million euros or dollars, no matter. Though higher amounts are not uncommon. Investors typically seek equity stakes between 15 and 30%. Consequently, the pre-money valuation generally falls between 7 and 50 million, with occasional peaks reaching up to 100 million. For valuation, startups can turn to methods like multiples, which is more relevant in this round than in the seed stage. However, the most common and logical approach remains discounted cash flows. A key consideration is the anti-dilution clause, often requested by investors to protect share value in future rounds. Additionally, Series A round investors often seek representation on the board, potentially changing the decision-making process. Now we talk about the impact on founders and the equity. Series A round has a significant impact on the equity structure. The sale of a large percentage can be tough to understand for founders, but it is crucial to obtain capital that allows growth. At this stage, many founders are faced with a delicate balance between maintaining corporate control and accepting investors who will bring expertise and resources. In addition, new investors can change the decision-making power of the founders. Because Series A's investors generally seek governance rights, such as veto power over certain decisions or oversight and strategic choices. Investor presentation strategies. In a Series A round, the pitch deck is a critical tool. The pitch deck for a Series A round should include a few key elements. Problem, definition and proposed solution. One of the first slides should clarify the problem the startup solves and why it is so relevant for the market. Second, market size and segmentation. Investors want to understand the target market, specific segments, and potential for expansion. The clearer the startup's position, the easier it is for investor to evaluate its growth potential. Again, business model and revenue sources. Clearly describing how the startup generates revenue is crucial because it's helpful to include sales channels, pricing, and revenue forecasting. Then, expansion roadmaps and plan. A growth roadmap with specific milestone market makes the expansion plan more tangible and credible. And again, financial projection. 3 up to 5 year projection that include profit and loss statement, balance sheet, and cash flow statement help investors understand financial sustainability. Competitive analysis. Demonstrating a clear understanding of the competition and outlining how the startup plans to differentiate from competitors, it is essential. And again, team and key competencies, dedicating a slide to the team presentation with a brief description of the core competencies and experience reinforces investors' confidence. The business plan becomes a key strategic tool, showcasing the startup's solidity and the scalability for investors. At this stage, the business plan should evolve from earlier version, incorporating detailed projection and well-defined growth roadmap. Elements of the business plan are: first, market analysis that include a thorough segmentation of the market and competitor analysis. Clearly understanding how the product or service stands out from existing players is a key to instilling confidence in investors. Operational plan and KPIs. The business plan should outline an 18 to 24 month operational roadmap, focusing on goals like entering new markets or achieving specific growth metrics. Key performance indicators, KPIs, such as user growth rate and gross margins are essential to track progress. And again, unit economics and financial projection. Investors pay close attention to the sustainability of the growth, providing concrete data on the unit economics such as customer acquisition cost or lifetime value clarifies how the company plans to manage cost and achieve profitability. Moreover, a 3 up to 5 year financial projection allows investors to evaluate the impact of their investment and potential returns. Fundraising strategy. Clearly outlining how the capital raise will be allocated is essential, detailing the percentage of funds dedicated to areas like marketing, product development, talent acquisition, or international expansion enhances the plan's credibility. And then risk and mitigation plan. Lastly, business plan should address primary risks along with mitigation strategies, demonstrating readiness to handle potential challenges or market shift, shows maturity and preparedness, and reassure investors. Success stories and case studies. As success stories are valuable sources of inspiration and insight. Spotify, for example, leveraged its Series A round to strengthen the platform and secure deals with major record labels, laying a foundation for rapid growth. But, for example, another one is LinkedIn, by investing funds in developing tools to boost engagement and attract professionals to its network. Now, I would like to dedicate some time by comparing the Series A round with the other funding rounds. In a startup's funding cycle, each round serves distinct goals. Before the Series A round, they are the early stage rounds, pre-seed and seed round. Focus validating the idea and building the product. Following the Series A round, Series B and Series C are generally aimed at supporting international expansion and market growth. For instance, a Series B round may fund acquisition effort or consolidate market presence. Understanding this progression helps founders set clear expectations for each stage. In summary, approaching an early stage round requires right preparation, experience, and a strong team. Success hinges on having a clear business model, sustainable projection, and the ability to demonstrate tangible growth because investors seek startups with an ambitious yet realistic vision and leadership capable of navigating challenges. Thank you for watching this video. If you found this insight helpful, don't forget to subscribe to the channel to stay updated on new content focused on startup growth. See you soon!